Can you give us a sense of what caused oil's big drop yesterday? Of course, we know the Fed's making its rate decision, the ECB also, but shouldn't that have already been priced into these markets?
No, absolutely. And I think the expectation has been for a 25 basis point hike for the Fed. Our colleagues at Medley Advisors have been expecting that as well. I think yesterday's move was probably more to do with the U.S. debt ceiling and comments by Janet Yellen talking about the fact that the U.S. might run out of money by the 1st of June. Obviously, that's probably a little bit exaggerated, but that definitely spooked sentiment. I do want to remind people what happened with U.S. debt ceiling negotiations back in, I think, 2011. It was we did see some huge drops in price or crude prices back then. And given the environment right now, there's so much uncertainty on the macro front. I am expecting prices to kind of remain under pressure until the debt ceiling is sorted out.
Okay, so a lot of uncertainty. I think everybody agrees on that. But give us a sense of where you think the oil markets are going. We're just looking at Brent crude and WTI at about 70 for WTI and about 73 for Brent crude. What's your price target for the time period when this debt ceiling deal is resolved, and what's your price target for year end?
So I think the easier bit for me is to talk about the price target for end of the year, right? The move that we've seen in crude has got nothing to do with fundamentals. Actually, fundamentals continue to tighten. We've seen crude stock draws counter seasonally. This is the first time in decades, over the past 2 decades, actually, only 2 times has the U.S. actually drawn stocks in April. So the market is tightening very slowly behind the scenes, and this is even before OPEC has cut. Physical differentials around the world are strong and holding. So that gives us a lot of confidence, and we do think second half of the year prices will go back above $100 as long as, again, the economy holds. We've already factored in a mild recession in our numbers. We already do see OECD demand declining. So that's all been priced in, mostly, I would say, and definitely factored into the balances. The problem is, as you ask, in the short term, could we see a 6 handle for Brent? Absolutely, yes, because the problem is the oil market's pricing in a very deep recession. Of course, the equity markets aren't pricing that in at all. The equity markets are pricing in a soft landing. Both could be wrong. The other issue is in the oil space, we have so many shorts. The discretionary money right now is outright short, and we haven't seen that in months. So any good news could trigger a lot of short covering, but I just don't see any good news on the horizon on the macro front.
So, Amrita, I just want to clarify really quick. So you're saying by year end, you see WTI crude going from $70 possibly up to 100, but in the in-between time, you see Brent going down to somewhere in the 60s?
And WTI as well. As in, my point is I can't rule out a 6 handle given if we, let's say, the debt ceiling goes to the wire, we're just going to get more and more bad news, and just it will spook sentiment.
All right, speaking of bad news and things that might spook sentiment, some news out today, the U.S. Navy reporting Iran seizes an oil tanker in the Straits of Hormuz. We also have some other big macro things, China ramping back up, slower than I think a lot of people expected, and then also the U.S. refilling the Strategic Petroleum Reserve. Those are a lot of things going on. I know it's kind of a mishmash there, but just give us a sense. Are any of those big catalysts, either to the upside or the downside for the oil market?
So I'd say on the Iran news, on any normal oil market day, that would be bullish. Anything in the Straits of Hormuz used to get prices up $5. Now the market's going to brush that aside because of just concerns about the economy. So I don't think the market's going to pay too much attention. China, it's interesting you say that. I've heard a lot of banks come out and say the Chinese recovery is slower than expected. It just depends on what they had expected. Chinese oil demand blew out of, it was absolutely enormous in March, well above our expectations as well. So the issue is the oil demand has been very, very focused on transportation, not manufacturing. And why? Because we are not consuming as much. US and Europe aren't consuming as much, and China, therefore, isn't exporting as much. So the manufacturing side is weaker in China, but that doesn't mean that the overall recovery is slower. It's just that that bit of the recovery has been slower. So we are continuing to see very strong demand out of China, and that's supporting the physical crude market. I don't think that's going to change. Last point of yours was on US strategic refilling. I don't think the SPR is going to get refilled anytime soon because they are selling SPR right now. This is a part of the mandatory release in Q2. Then they have maintenance on their cavern. So the earliest they're going to do something is going to be Q4.